Hello and welcome to the latest edition of The Exchange, brought to you by the New York Stock Exchange. I'm Douglas Jonas, your host. As a reminder, today's interview is for informational purposes only. The NYSE does not recommend investments or investment strategies. Now, I am atop the trading floor right now with Sebastian Page. He is the head of Global Multi-Asset and Chief Investment Officer at T. Rowe Price. Sebastian, thank you so much for joining us.
Thank you. Thanks for having me.
So let's talk a little bit about the market over the past year. I mean, what do you think have been the biggest surprises?
You know, because 2022 has been so eventful so far with the war in Ukraine, we've kind of all forgotten how we started the year before Russia invaded Ukraine. But my view is you can't fully understand the current macro environment if you don't account for the fact that the war exacerbated supply chain, inflation, and rising rates trends that were already in place. So if you think back at 2021, price earnings ratios were down in part because of rising rates, but stocks were up. The S&P 500 was up 27%. Why is that? Well, because we had really strong earnings surprises, 30% to the upside. That was a surprise. Another surprise about 2021, which is highly relevant to the current environment. In 2021, bonds lost money. Barclays Agg lost 1.6% before inflation. And this is rare. It's happened only, if you look at calendar years, 4 times since 1977, 4 times in 45 years. Now, the other thing is, where we started in 2021, you'll remember we didn't expect that much COVID. Vaccines were coming online, and we thought, well, we'll get rid of this thing at some point pretty soon. But then we had Delta, the Delta wave. Then we had Omicron. And that really influenced the relative returns between value stocks and growth stocks. Well, right now, COVID is still a factor, with some shutdowns or lockdowns in China, which are still impacting the supply chain. Now, another big surprise about 2021, which is highly relevant, and it's a trend that's being exacerbated right now by the war and by other supply chain issues, is that inflation was not transitory. Supply chains jammed. I call it the mother of all traffic jams. Well, we're still dealing with this. And then lastly, another trend that's continuing this year, and that was kind of a surprise in 2021, is we had a bubble burst. If you look at the performance of non-profitable growth tech stocks leading into the current environment, that index was already down 44%. Think of the ARK strategy, already down 50%. So my point is, we entered the year with conditions that were only exacerbated by the war. And that's how we ought to think about investing in 2022.
Yeah, and let's stay on that theme, right? Because you're talking about a lot of surprises as well as a lot of challenges. So maybe let's start there. When we think about 2022, and you're an investor out there, how can they best manage their risk given all the challenges around us right now?
Yeah, look, I could say right now there are 3 big challenges for markets. Inflation, inflation, and inflation. I'm just saying that tongue in cheek. We have a war, we have COVID, we still have supply chain issues, China's slowing down, Fed policy is a worry, and we're withdrawing liquidity. We have a lot of things to worry about. But the reason why I say inflation, inflation, and inflation is because inflation is it's transmitting all these macro events into financial markets. It's a transition mechanism between the most important macro risks and their impact on financial markets. In a rising rate environment, right? You can get positive stock returns, but you need earnings to come through. This was the story of last year. But this year, with inflation running even hotter, and you have wage growth, you start to worry that wage growth is going to eat into corporate margins and jeopardize earnings. So that's why inflation is just so important. Or think of the consumer and how important the consumer is for GDP growth. Well, higher gas and food prices are clearly a tax on the consumer. Once you've paid for these things right now, you have less money left to spend on goods and other things. And of course, the number one worry for macro markets, for the world financial markets, stocks, bonds, alternatives, is that inflation is really forcing the Fed's hand. So it's still possible that the Fed will continue to have to raise rates. So, ultimately, inflation.
And, Sebastian, you bring up the Fed, you bring up a rising rate environment. How do we then start to think about treasuries? Will we think about asset allocation? Where do investors place their fixed income allocations?
Yeah, that's a really good question. It's very important right now. The 12-month correlation in terms of total return between stocks and treasuries is the highest it's been in at least 10 years. And the first quarter of this year was remarkable from that perspective. The Bloomberg Global Aggregate Index turned 33 years in January. Q1 of this year was its worst calendar quarter ever. It dropped by 5%. It's rare that you see bonds, high quality bonds, drop by 5%. But what's more unusual is that this drawdown in bonds occurred in the same quarter as a similar drawdown in stocks, hence the high correlation between stocks and bonds returns. When stocks go down, aren't treasuries supposed to go up? And that hasn't happened. And given that stocks were down 5%, if you're into statistics, the probability that bonds would also be down 5% or worse, according to what we call the normal distribution. And by the way, I don't think that's the way necessarily to measure risk, but according to that type of models, that probability that you get stocks down 5%, bonds down 5% or worse, this type of event should occur statistically according to the normal distribution once every 17,000 years. In financial markets, we call those tail events. They definitely occur more frequently than predicted by those types of models, and that's why we use the term fat tails. Stocks and treasuries tend to go down together when rates and inflation volatility drive markets more than growth shocks per se. And we're in a regime where rates and inflation are going to be more volatile and are going to drive markets more than they have in the past. So alternatives have a more important role to play in portfolios, all else being equal. In some of our models, we have about 12% allocated to alternatives. When you select alternatives, you want to make sure you're not just selling volatility. There's a selection aspect to investing in alternatives that's very important. And I will just say this, having said all of this, treasuries, I believe, still have a role in the portfolio when you get a real recession shock, which is not our base case, but is a scenario that could occur over the next 1, 2, or 3 years.
Thank you so much, Sebastian. Now, as a reminder, if you caught this episode live and you're looking for additional ETF thought leadership, you can find a lot of that content on our website, homeofetfs.com. That's homeofetfs.com, all brought to you by the New York Stock Exchange, the home of ETFs.